You've heard about stock options, right? People making thousands of dollars on tiny price moves, or losing their entire account in days. But here's what nobody tells you. Options aren't some mysterious dark magic reserved for Wall Street. By the end of this video, you'll understand exactly how they work, why people use them, and whether they're right for you. I'm breaking down stock options like you're hearing about them for the first time. No jargon, no BS. Hey everyone, welcome back to the channel. Before we go any further, I need to say this. Options trading is not like buying regular stocks. If you lose money on a stock you hold, it goes to zero. With options, you can lose 100% of what you invested in days. But, and this is important, when used correctly, options are actually tools to reduce risk, not increase it. So if you're curious about how professional investors use options, how to protect portfolios, or how to generate income from stocks you own, keep watching. By the way, this isn't financial advice. I'm just explaining how options work. Talk to a financial advisor before you actually trade anything. Okay, let's start with the basics. A stock option is a contract that gives you the right, not the obligation, to buy or sell a stock at a specific price on or before a specific date. That's it. That's the core concept. Let me use an example. Say Apple stock is trading at $150 right now. You think it's going to go up, but you're not sure when. Instead of buying 100 shares for $15,000, you could buy what's called a call option. This contract says, I have the right to buy Apple stock at $150 per share anytime before January 20th. Why would you do that instead of just buying the stock? Because options are way cheaper. A call option on Apple might cost you $3 per share times 100 shares per contract, so $300 total. That's 1/50th the price of actually owning 100 shares. Now, if Apple goes up to 170, your option is suddenly worth a lot more. You can sell that contract for a profit, or exercise it, meaning you actually buy 100 shares at 150 and immediately sell them at 170, pocketing $2,000 minus the $300 you paid. But here's the flip side. If Apple stays at 150 or drops, your option expires worthless, and you lose that entire $300. There's also the opposite, a put option. This gives you the right to sell at a specific price. If you own Apple and you're worried the stock might crash, you could buy a put. It's like insurance. If Apple does drop, your put option makes money. Your put protects you. Let's break down the moving parts, because options have their own language. The strike price. This is the price you have the right to buy for calls or sell for puts the stock at. If Apple is at 150, you might buy a call option with a strike price of 160. That's called out of the money, because Apple would need to go up past 160 for the option to be worth exercising. The expiration date. Options don't last forever. They expire. Most options expire on Friday of expiration week.